Proud supporters of Africa this week. Engine, with us, you are number one.
Hello and welcome to this edition of Africa This Week, your wrap of what happened across the continent. I'm Mashudu Masuta. Rising wages and costs will soon push up the price of cheap manufactured goods from China. South African and continental importers should be aware of the trend and understand that they will ultimately have to source elsewhere globally and locally. This according to the report by South Africa's first-rand bank's financial markets team.
We've also got a much more important development in that China has been so successful that wages are starting to rise, salaries are starting to rise, and this is starting to put cost-push pressures onto Chinese corporations. And that, of course, has got very important implications for the global economy. And really what we did at Rand Merchant Bank, the point we're trying to make is that these cost-push pressures in China, rising price of producing goods, plus the appreciation of the Chinese yuan, means that Chinese goods are no longer going to be so cheap to import into South Africa. In fact, our work shows that in the next 3.5 years, the price of the cost of importing goods from China could rise 77% in South Africa. This China price is not going to be here forever. South African retailers are eventually going to have to look at other markets to source their goods.
This week's failed merger talks between Nigeria's third biggest lender by market value, First Bank, and rescued Oceanic Bank has thrown up interesting questions about the process of finding investors for Nigeria's rescued banks.
I think First Bank was looking at acquiring some accounts, especially because Oceanic was known for its commercial banking and it had a lot of commercial banking prowess in the market. I think that's what First Bank were looking at. I don't think they were looking at the branch network or the systems or the reach of Oceanic. I think that's where the disconnect with the Oceanic Bank in terms of valuation came into effect, because First Bank knew what they wanted to pay for.
And then what are the options for Oceanic Bank right now? Obviously, if First Bank walks away, what next for them?
I think in terms of Oceanic, I mean, there should be a reserve bidder. So I think they might probably go to the reserve bidder and see if they can come to an agreement there. If they can't come to an agreement with the reserve bidder, then it's up to the CBN to decide what to do.
And then there's a sense that this process has actually dragged for quite a while. August 2009 is 20 months away. That's when the central bank initially went into these banks and intervened and took over management, etc. What is the way forward? Because there's a sense that this issue is just dragging. Is it a question of going past these elections and then we might see some speed and traction on these transactions?
The whole process has been very political from the start because of the size of these banks and some of the personalities involved, and that slowed down the process. I think in terms of what the process has dragged on, I think trying to sell 7 banks, three of them, some of the top 6 banks before the CBN intervention in the market is always going to be difficult in any country. I think the fact the process has reached this stage is testament to the CBN's advisors and also the bank boards that have pushed this through. Now, this is the most difficult part, actually agreeing valuation, agreeing price, and getting shareholders to agree. And that is always going to be the most difficult part. But it needs to be done because at the moment, the banking market is a bit artificial because you have this CBN guarantee. Now, until that CBN guarantee is lifted, we're not really going to know the true state of the Nigerian banking sector in that sense, because a lot of, like the interbank market is protected by the CBN guarantee. Lost these rescued banks, the depositors are still there, because of this implicit CBN guarantee. Are they going to still be there after the guarantee goes? No one knows. Until that guarantee is gone and the market is running by itself before we know the true state of the Nigerian banking market.
Kenya will incur an extra 28.1 billion shillings in its external debt following the fall in the value of the shilling against world major currencies. Vitalis, a major policy advisor at Kindred, explained the connection between currency volatility and Kenya's national debt.
Kenya indeed can afford to absorb this debt. The question would be what kind of investments they would be making in terms of development programs, but also in terms of infrastructure development that should indeed spur growth. Above that would be the question of how much they actually put to research and development and universities to develop or create new necessary human capital that could facilitate the kind of growth that they envision.
Now, obviously, we have heard that Kenya's national debt has risen by 5.2% over the last 2 years. The deficit also is something that international banks are concerned about. What do you make of fiscal management in Kenya?
I think Kenya's debt, particularly the external one at the moment, has not reached a threshold that could be seen to be dangerous. The only problem would be whether the debts are being managed properly within the context of proper investments that bring proper returns, but more so if the government is actually investing this money in relevant sectors, productive sectors that could create employment to the people. So in terms of fiscal management, I think at the moment is expansionary, but we are yet to see whether they will actually yield good results for the economy, but more so for the people of Kenya.
Kenya obviously recently extended or qualified for an extended credit facility with the World Bank and the IMF. There's a lot of multilateral donor support in financing this debt, but effectively it puts multilateral concessional debt in the region of 64%. Is that sustainable?
Well, sustainable concessional loans are not really bad because they don't attract a lot of interest as commercial loans. So I think in the long run, if the government focuses on getting concessional loans, they are on the safer ground. But in a scenario where concessional financing is actually dwindling or reducing, Kenya will have to really re-examine its policy on borrowing externally, given that the cost of borrowing is increasingly going high due to higher interest rates, but also given the fall in Kenyan shilling, as we've been experiencing over the past 2 or 3 years.
Each spring, the World Bank IMF Development Committee meet to discuss progress of the work of the World Bank and the IMF. Amongst other things, discussions focus on the global economy, international developments and the world's financial markets. For the IMF and World Bank's perspective on Africa, we had Wolfgang Fengler, lead economist at the World Bank in Kenya.
There are lots of issues that have been dealt with, including a few others: conflict-affected countries, the crisis in the Middle East, and the impact on regional economic development, especially as well as the African issues, including on Cote d'Ivoire. But I think the two key economic issues to highlight are, one, that the global economy is now on a path of strong recovery, not as strong as it was last year. Last year was 3.5% globally. This year may be slightly lower, but you have a robust recovery amidst all this turmoil, some of which you mentioned. And the second issue links to the debt challenges that you highlighted as well, which is that if you just take the emerging economies and the rich countries, you have a complete inversal of the situation that you had a few decades ago. Now it is the rich countries which are heavily indebted, above 100% of GDP, and the emerging economies which are declining. And maybe let me just, Loretto, add a third point, which our president and the World Bank put at the center of the spring meetings, which is the issues related to the increase in food prices, which have risen by 30% over the last 12 months and which pose a heavy burden and tax on the poor.
Let's talk about the issue of the currency wars that were very prominent in year 2010 and the fact that some emerging market economies are intent on manipulating their currencies to make them favorable for exports and then driving an export agenda internationally. Is that still a major concern?
I guess it is a concern, given we are now in a new world, which is a multipolar world, and you see not just the trade issues between China and the US, but also with other emerging economies. And as you indicate, it needs also two to tango. So the question of the US monetary policies come into play, which then generates the capital that's then being translated or flooded into other markets. But there's one encouraging statistics. If you take the US-China relations, 3 years ago, you had massive current account surpluses on the Chinese side and massive current account deficits on the US side. And both have been shrinking and narrowing, especially China, which has had roughly 6% current account surplus in 2008, has been reduced to 1% now. And that is one of the more encouraging signs on the current account and currency developments.
What does the IMF and the World Bank indeed have to say about the pace of global recovery? I think in the middle of last year, we were starting to be very encouraged by the fact that we were seeing positive growth in many of the developed economies and phenomenal growth in emerging markets. You mentioned the threat of global inflation creeping in. Are those gains going to be reversed?
our projection is still you see robust growth this year in the range of 3%, and the World Bank will issue its global economic prospects in early June to reconfirm those numbers. Last year, as I said, was 3.5%. So you get into this more stable equilibrium, and with a big gap between the rich and the poorer countries, where the emerging economies are driving global growth, as they have basically also saved the global economy after the global financial crisis. But as you highlighted, the issue of inflation, especially food and fuel, are those which are the biggest risks out there. And if you would see a continuation of the Middle East crisis and even an acceleration of that crisis and much higher fuel prices, then this recovery would be at risk.